This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 142. Interest rates. Have they anywhere to go?
Welcome to the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie. Today, interest rates, have they anywhere to go? Interest rates have been low in most parts of the world for some time now. In many places, they're actually negative. So what do central banks do next time there's a global economic downturn? Which, as we discussed last time, isn't very far away now. That's this time on the Debunking Economics Podcast. So interest rates in most parts of the world are at record lows. In Switzerland, for example, the current rate is minus 0.75%. It's been there for 4 years. Sweden and Japan are also in negative territory, while the Eurozone, governed by the ECB, of course, the European Central Bank, is on a flat zero. And Japan has barely been in positive territory this century. So when will it rise, if ever, and what are the consequences? Well, let's start with an obvious consequence, Steve. I mean, low interest rates create debt because people think it's cheaper to borrow, but that's perhaps a bad thing, but surely also it means people spend, which is a good thing.
Well, I think they're doing neither, unfortunately, because when you're carrying, if interest rates were zero and debt was also zero, you wouldn't think twice about taking out a loan. Interest rates are almost zero because debt is massive compared to income. You have 1.5 times GDP in America, more than twice in Australia, and so on. And then virtually 2.5 times the places like Denmark and so on. So the low rates, yes, they make it enticing to take on new debt, but there's so much debt out there already.
That's why it's there. Yeah.
Yeah. Okay.
So how do we get to that stage then? Why did we all of a sudden start borrowing to the point that central banks had to drop interest rates so significantly?
Well, I think because the central banks and the governments in general basically said debt's a good thing. This is one of my main complaints about neoclassical mainstream economics. They effectively demonized equity and enhanced debt, because the way they teach this is the thing called the capital asset pricing model, which is their overall way to try to interpret what happens on stock markets in an equilibrium way. And as part of it, they have what they call the Modigliani-Miller hypothesis. And this simply says that if you they ask the question, does the level of corporate debt affect the valuation of a company? And they say, no, it doesn't, because it's quite possible for a highly levered company to be bought by somebody, have its shares being bought for cash, or a lowly levered company to have its shares being bought by people who borrow money. Therefore, on that a priori argument, there's no relationship between the level of corporate debt and the level of share prices. Now, that is absolute and complete empirical bunkum. Well,
you'd look at growth as well, though, wouldn't you? So you'd say it's okay having a highly leveraged company if it was growing very quickly, because obviously investing to fund that growth.
Yeah, but none of this gets into this mainstream theory. It's all thinking in terms of equilibrium, and it's thinking in terms of rational agents who can offset what other rational agents do. So the whole idea is to neutralize any role for the government in the economy. That's the ideological bias of this economics. What they pretty much said was, with the Modigliani-Miller, if you get an interest rate deduction on your tax payments, which you don't get an interest rate, you don't get a deduction for your dividend payments, then the best situation for a corporation to be in is 100% debt finance and 0% equity. Now, that was a major part of the ideological backing for the whole leverage buyout world that was the 1980s in particular, the greed is good period, but it still hasn't gone away, and in this sense have actually encouraged corporations to take on that level of debt. So to me, it's been a bad economic theory leading to a bad idea that should mainly be debt financed, when for robustness, and this is something that Nassim Taleb talks about very eloquently, the height of anti-fragility, the more debt you have, the more fragile you are. The more equity you have, the less fragile you are. So we need a less fragile world which relies more upon equity and less upon debt. Yeah,
but it's interesting, isn't it, how even mainstream economists are very divided on all of this. So let me give an example. Paul Krugman versus David Malpass. So David Malpass is the economist who's been nominated by Donald Trump as the chief executive for the World Bank, who was arguing several years ago that the US should lift interest rates because otherwise we're going to see a surge in asset prices. Well, guess what, David? too late for that. Paul Krugman, who I know you love dearly, he's criticised Malpass because he says he's got this concern that low interest rates discourage thrift, which he says is bad for the economy. So Krugman definitely fits into that camp of no, keep interest rates low so people borrow more, so that helps growth in the economy. But here we've got a man who's sort of like going to be in charge of the World Bank, who's thinking, well, maybe it should be, sort of saying, it should be the other way around. At least certainly, interest rates need to be higher, so we try and discourage that sort of behaviour. But the horse is bolted, of course.
Yeah, I think what we're in now is a low interest rate world, whether people want it or not, because any increase in interest rates is going to cause the private sector to fall over, and this is the point that Paul Krugman will never get his head around, because he's still thinking in terms of loanable funds. When you borrow money, you increase your spending capacity, but the person lending it to you reduces theirs, and then when you pay it back, the person who borrowed has less spending power, but the person who lent has more, and one balances the other out. And that means that there's no significant impact on aggregate demand with the independent level of private debt, which is, unfortunately, to use a technical term, we can use these words on the podcast, bullshit. Is that okay?
Yeah, okay.
That's okay, good.
I love podcasts for that reason. You can say what we want. That's
right. Yeah. No radio regulator getting in the way.
No big red button here. No.
When you say there's banks create the money, they write an entry on the asset side creating a new loan, they put the same amount of exactly the same number into your deposit account or into the account of the person you're buying something off as the liability of the banking sector. That growth and expansion of money increases and decreases demand equally as well. So you don't have a capacity with low interest rates for people who are borrowers to counteract the lack of spending by those who are lenders. What you actually get is low rate of growth of credit and low economic performance. And any putting up of interest rates will encourage people to pay debt off, which reduces the money in circulation and reduces demand as well. So you're locked in where you simply can't let rates get off the floor. And I think the long-term history of interest rates, until the levels of private debt fall for whatever other reason, it won't be conscious policy that does it, the long-term prognosis for interest rates is to remain low. And any uptrend is a chance for anybody who is in the bond market to speculate on the rates falling again.
Yeah, you make a lot of money doing that sort of stuff. But I'm just wondering how bad long-term low interest rates are. Okay, obviously there's that whole issue about asset bubbles, but there's good debt and bad debt, isn't there? So in theory, if you've got low interest rates, then that encourages you to take risks with your borrowing. So, and risk taking obviously creates innovation, which can create future growth.
If the money goes to innovators, but the trouble is it goes to speculators with the modern banking sector. Yeah. And this is the major problem that I see with leaving the banking sector.
But it's still the speculators are still taking risks, though. So they would be speculating.
Taking risks.
They're taking risks all the time, but they would. Presumably, there's going to be a high return for taking a risk on something which is quite innovative. I mean, are they two mutually exclusive?
Well, it's actually a lovely distinction that one of my favourite economists, John Blatt, the old professor of applied mathematics from Australia, made the case in trying to argue against net present value thinking in terms of evaluating whether you should purchase an asset or not. He said you have to distinguish between investment, what he calls placement. He said investment is something where you buy fixed capital. You're actually building a productive factor of some description. Yeah. Placement is when you buy shares. I have a personal, I love embarrassing my brother-in-law on this front, lovely guy who's got a very strong ethical attitude to investment, and he decided his self-managed superannuation fund would only hold ethical investments. And I didn't have the heart to tell him that he was buying shares of other speculators. He wasn't getting any money to people like Cochlear in the first place, because it was the second-hand market where you buy
makes no shares. Difference. Yeah, exactly.
So this, if you have money going to people who are doing a placement game, then what you get is volatility in asset markets. You don't necessarily get innovation, and that to me is the major weakness of the banking sector. I would far rather see the banking sector providing working capital to existing corporations and innovation capital to entrepreneurs than doing what it's doing at the moment, where it basically doesn't provide any money of any real substance to the corporate sector. in the way compared to what it used to in the 50s and 60s. It just basically lends people to gamble on asset markets.
Well, you should be telling him to buy corporate bonds, shouldn't you? Because that is an investment then.
Yeah, and that's what I think the major level of the debt we're seeing is corporate bond issuance, and that often ends up being banked up by bank loans as well. It's the banking sector gets its fingers everywhere. But in terms of direct provision of money for investment, the level of money firms used to get for lines of credit that can enable investment just aren't there anymore. I've got to do a cough, mate. Pardon me.
But what about? I mean, if you are, and this, I guess, this is what's clear evidence that it's not working. If you are using that low interest rate to invest rather than just placements, as you describe it, then you'd be saying, well, okay, that investment obviously is there to try and make you more productive, or to create new goods, or create the goods that you're doing now more cost effectively, which would mean we'd see productivity increase. And, we haven't seen that for a long time. So even if there is this investment, where's the productivity gone?
Yeah, I don't think investment is really taking place. A lot of what's going on is share buybacks and things of that nature.
Yeah.
And letting capital stock run down. The one country which has been doing solid investment throughout is China. And in that sense, that's why there's been such a dramatic advance in China's productivity per worker versus what's happened in America. The change, I mean, it is in over a 30-year period is quite stunning. If you went back 30 years in America, you're talking the late 80s. You're caught in a bloody stock market bubble at the time. You need to go back to the 60s before you see substantial investment-driven behaviour in America, whereas China has been investing flat out for the last 30 years, caught up in a property bubble in the last 10, but dramatic level of investment in new technology and in training and capital stock and infrastructure as far as the eye can see.
Of course, we should get a good balance of trade if we've got low interest rates. I mean, in theory, no one's going to want your currency if the interest rate is low. So the value of your currency is going to go down if you've got a low interest rate, and that is going to make your exports cheaper and imports more expensive. Doesn't work, of course, when interest rates are low everywhere. But I mean, that's supposedly another benefit of low interest rates, isn't it? It should help your balance of trade.
The trouble is that every country in the world's got it right now. So
yeah, exactly. Well, actually, and the ones that don't have those low interest rates, 1.5% for Australia and 1.75% for Canada, of course, they are commodity currencies by and large. Interestingly, though, Australia's got a positive trade balance. Canada's got quite a hefty trade deficit.
Australia normally has a trade deficit as well. It's just, I think it's a passing fad that it has a trade surplus right now. It's courtesy of coal prices and to some extent iron ore prices. So I don't expect that to continue. So
any influence on the balance of trade doesn't really matter because we're stuck with it, basically.
Yeah, it's not a differentiating factor between different countries around the world. I mean, yes, you've got the lovely story of Switzerland offering a negative rate. That really is to discourage people buying the Swiss franc as a hedge. So that's why it's minus 0.75. You're actually, what it isn't people individually are being paid negative interest on their bank accounts, but it says anybody who deposits money that turns up the bank itself, the central bank, the private bank has to pay interest on its deposits at the central bank rather than vice versa. And that's to discourage that particular speculative flow. And that's try to keep because when the Swiss broke from the peg they had with the euro, the currency dramatically appreciated and they want to keep that under control. That's what the negative rates are there for. But generally speaking, you look at everybody's in a band between 0 and 2% pretty much all around the planet right now.
Yeah, well, I mean, there's only a few exceptions that are really over 1%, really. This whole thing about trade balances, though, I mean, I'm fairly convinced Donald Trump's seeing this. If he can get interest rates to stay low, then, just as I described, the textbook he read is obviously telling him that that's going to help your balance of trade ultimately.
Hang on a sec, textbook?
You don't think he's read it? Well, the textbook his advisors have read then, sorry.
That's possibly true.
Yeah, they're telling him that if he keeps interest rates low, then his trade balance is going to improve.
Yeah, he is actually obsessed by the trade balance, and that's something that's an obsession I share. I think we actually dramatically, and this is one of my criticisms of modern monetary theory. I think it underplays the importance of the trade deficit because it's so American centric in its thinking. And to me, the trade deficit, if you're not producing the global reserve currency, then your trade deficit makes you vulnerable. And now, some extent, Trump doesn't realize that the trade deficit doesn't matter because he has the global reserve currency. However, the thing which got him into office was appealing to all the workers who lost their jobs as production was relocated to China.
Yeah.
And on that front, yes, the trade deficit does matter because it's actually recording how many people are no longer working in General Motors. And now if they're lucky, they've got a job in Henny Penny. And he is picking up on that angst of the American working class. So he does want interest rates to be low so that people will invest in corporate bonds for investment to get those jobs back. Surely, yeah. But I don't think it's going to work because the level of corporate debt is already at a American record.
Yeah.
So it's this old problem. If you want to have higher interest rates, you've got to have lower debt. And, of course, that's the last thing which is being addressed right now, lower debt in terms of private debt, not government. And that's the last thing which is being addressed by anybody anywhere on the planet. So I think in that case, because they can't see what the problem is, we're stuck with the symptom, which is low interest rates.
So why is this so pervasive? Why have we got low interest rates everywhere? Why have we got high debt, inflated assets being driven by those low interest rates, or the other way around, really? And, in the same situation around the world as well, that central banks are afraid to raise rates. Why is it so pervasive? We would expect countries with lower household debt would have higher interest rates. Yet if we look at Australia, household debt is well north of 120% of GDP, but interest rates at 1.5%, which is, higher than most countries. But generally, as you say, we're all in the same boat. How did it get there? How come it becomes a global phenomenon? Why aren't some countries exceptions?
This is because they're all reading the same textbook. I've just been reading some work of one other person. I have a bit of respect for him, but he's one of the main problems as well, Paul Samuelson, because he's the one who gave us this whole view to economics. What they call Keynesian economics was actually Samuelsonian economics. But because this whole theory is equilibrium-oriented, sees capitalism as an equilibrium system, believes that they ignore the level of debt because of the loanable funds model, so they don't even look at any accumulator in the system like private debt, actually encourages debt over equity, which is what the whole the whole capital asset pricing model has done. We've all let ourselves, Australia, we've basically got a whole bunch of ship captains who don't know what a boat is. And that, to me, is why we're walking into the same bloody wall at once. If we actually were conscious of the role of the financial sector, we'd never have gotten into this problem in the first place. But
if we continue to have growth, is it a problem? If we've got high debt and low interest rates, but we've still got growth, that's not an issue, is it? Well, when does it become an issue?
The growth is fragile because, again, you have a demand-constrained economy. This is another classic error in mainstream economics is to see capitalism as supply-constrained, when in fact it's fundamentally demand-constrained. If you want to increase your supply of something, you've got to generate the demand for it. And overcapacity is the rule, not undercapacity, et cetera, et cetera. All these issues, something we know empirically from looking at the real world, which neoclassical economists completely avoid reading that research. So in that demand-constrained world, if you want to have the growth in demand, then you've got to have it coming from some monetary source. And if you're putting constraints on what the government sector can do from believing that government shouldn't run deficits in the first place, tick that box. And if you're also ignoring the private debt's risen to unsustainable levels, and therefore you won't get much credit growth in the future, tick that box. The one thing you're left with is running a trade surplus. Well, that's a zero-sum game, and America's, running a deficit. So
yeah, but still growing. But as you say, they've got the reserve currency on their side. But central banks, what do they love to talk about themselves calibrating the economy as though they're fine-tuning something that only they control. But I mean, they have sort of, because they've let us get into this situation, they've sort of made themselves redundant, haven't they? Because if we look at, let's take Switzerland as an example, another country with a very high household debt, a very low interest rate, it's minus 0.75%. It's one of the, I think, the worst, the lowest interest rate in the world, I think. Yeah. Yet it has a GDP growth rate of 2.4%, but it was 3.5% in the middle of last year, so it's on the way down. If they start to really tank, they have no instrument left to do anything about it because their interest rate is already minus 0.75%, which is the only instrument central banks have got. What can they do?
Well, the central banks themselves, one thing they're trying to do, and I'm willing to go to the barricades of this one. They want to abolish cash to make negative rates even more effective, because they think if we have negative rates, that'll encourage people to spend. So you put a negative rate on a deposit account, because the Swiss haven't been able to do that because they still have a physical currency. If you put a negative rate on a bank account, people won't bother putting their money in the bank, and you'll have a leakage of reserves from the banking sector going into cash. Which just is unsustainable. So, but what they're trying to do is say, let's abolish cash then. The only place you can hold money is in a bank account, and therefore we can put negative rates on bank accounts, and you've got no choice. You can't take your money out. I think this is a horrific thought, but that's actually what I see a lot of central banks talking about in their diluted dynamic stochastic general equilibrium world.
And because it closes it, doesn't it? It creates more of a closed system for them, but it's very big brother, isn't it?
It's extremely big brother. And this is what I find quite ironic about the whole progress of neoclassical economics, because it began in a fundamentally libertarian way. They believed that they were going to prove the existence of the invisible hand. And what this meant was that everybody could now do their own thing, and the market would work out the best situation overall, regardless of what people thought. When they couldn't get the mathematics to work for their various models, over time they've drifted, without even being conscious of it, to believing we're all gods. We all have this incredible capacity to understand what the economy should be at. Therefore, we can jump to this particular situation in the process. And they actually, of all things, and you read a neoclassical model these days, it will often say a central planner decides to maximize the time path of utility versus work for the economy. And then they prove that in a perfectly competitive equilibrium, the time path of the economy is the same as will be chosen by a central planner. What the hell is the idea of a central planner doing in a model of capitalism? But that's where they've got themselves to without even being conscious of it.
That's an interesting dichotomy, isn't it? But I mean, let's place ourselves in this future world, which might not be that far away. Then, if they got their way, where central banks say yes, all money must be kept in banks. Maybe we'll give you £5 or £10 spending money. Spend it wisely, because that's all you're getting in cash if you want to get yourself a coffee and the like. But everything else has to be kept in a bank. Then they will say, well, okay, minus 0.75% interest rate isn't a problem. In fact, we can take it to minus 3% or minus 5% if that's going to encourage spending and investment and growth.
And that's the sort of stuff you can find in Krugman's logic as well, by the way, in a recent set of papers.
Where do you stop? Minus 50%. You've got the money now. You've got to invest quickly.
To them, the whole problem, the reason capitalism is in a funk right now, according to the mainstream, is the zero lower bound, because they believe the interest rate can hit an equilibrium level of employment as long as you get what they call the natural rate of interest correct. And to them, at the moment, the natural rate of interest is actually negative. So if we actually eliminate the zero lower bound by making it possible to have negative interest rates for consumers now in bank accounts, bang, we can restore equilibrium by pushing the rate negative enough to inspire an increase in the level of spending to give us full employment. And I think, holy hell, they've done enough damage to the economy if they try this one. We're in hell in a handbasket, because if you have negative deposit rates, are you about to take out a loan?
Yeah, no.
If you take out a loan, you're going to be paying positive interest to the bank and getting negative interest on the money you put in your account. It does not compute.
So that's the end of industry.
That's the end of capitalism.
Yeah. Well, yeah. I wonder if they've thought this through.
Of course not.
Let's
Within their model they have.
Yeah. Let's have a look at countries where there are, because I said wrongly, I think that that it's low interest rates everywhere. There are countries still where they do have very high interest rates. Turkey is an obvious example. 24% is their interest rate now. It's just gone up. Their GDP per capita is falling. Unemployment is rising, but also inflation is very high, which is why they've pushed it all up. Inflation is over 20%. So this is a central bank doing, what all the others did a long time ago, trying to control inflation by pushing interest rates, by controlling interest rates. So talk us through what they should do given that situation and why it's not working for them, because they're pushing those interest rates up, but inflation is still very high.
Yeah, I mean, I'm not going to claim expertise in developing economies, so I tend to be. This is where I'm going to be saying I'm just,
who knows?
On my standards, I'm waffling. But to me, a major factor behind the Turkish bubble has been the government's been running a deficit of the order of 20% of GDP for some substantial time, and in line with what I argue about that, ultimately that means if you've got to be buying capital goods from overseas, you can't build a blast furnace using Turkish steel. You can't import a Turkey. You can't. There isn't a manufacturer of blast furnaces in Turkey. So I don't know that, but I'm willing to stick my neck out and say there isn't.
Yeah.
So you've got to buy the capital goods to increase the physical capacity of the economy while you've got this huge monetary boost. And therefore, you've got to be issuing bonds which are denominated in American dollars. And that therefore means people saying, what's the capacity for you to pay this back? And then they'll speculate on the currency market that your currency won't be able to support it. And bang, you start getting a massive fall in your your balance of your currency, and therefore a blowout in domestic prices because you're importing essential goods.
And that is what happened. That is what happened. I mean, the lira's exchange rate has been falling quite significantly in the last few years. So,
I think in that case, Turkey has overdone the government deficit trick. A lot of this has been, from what I've been told from friends in Turkey, this is a large part of the political appeal of Erdogan. He's actually used this to have a huge construction projects that are giving wages to people from the countryside who are more conservative and more likely to vote for him. So it's had a large political flavour as well. Yeah. And in that situation, you simply can't run a government deficit that big. You've got to probably whack up tariffs as well. To stop it, just bring in capital controls, all the stuff that was done by Mahathir back in the Asian financial crisis. But of course, Turkey's not a major exporter. Yeah. So the one thing I think that Erdogan's doing, which is sensible, is trying to develop a payment system in the Islamic countries so that they can bypass the American dollar.
And I guess, I mean, textbook principles say, look, if if you've got high interest rates, then people would want to buy the Turkish lira. And yet, as I say, the exchange rate's been falling quite a lot. But that is because, even though in theory it makes sense, financially to buy the lira, who would want to buy it? Because it's such a high risk. Yeah.
And it's actually just intriguing looking at the data right now. Turkey actually has got a falling level of government debt, which probably implies the inflation rate is higher than the government deficit is. So even though it's been running this huge government deficits, the actual level of debt's been falling compared to GDP from about, I'm eyeballing this right, from about 80% of GDP to about 30% of GDP. That's rising right now. But if you look at the level of private debt in Turkey, surprise, surprise, that's rising. It's nothing gigantic, but it's gone from of the order of about 30% of GDP to about 100% from 2005 till now. So that is likely to go negative as well, and Turkey will have a credit crunch.
So what can in that situation? What can a central bank do then? I mean, they've pushed up interest rates. Should they just carry on down that road?
I think, and that's in one case, I'd be saying you've got to whack on tariffs. Yeah. Rather, I'd be using trade policy. Which puts me, of course, outside the mainstream completely, and you've got to start.
Not for the first time.
You've got to build industrial capability inside Turkey, which I think has been ignored. A lot of the construction work, again, from what I've been told by Turkish friends, has been sort of shopping malls and stuff like that. Great for a retail culture, not good for a production culture.
Yeah, well, that's a mistake being repeated all over the world, isn't it? So let's finish by looking at the United States then, because they've been on a zero interest rate period. They went into it in 2007. The last couple of years, we've seen interest rates rise. It's 2.5% now. So they've moved from that long zero interest rate period to a period where they're quite high. And now we've got plenty of signs that the economy is slowing, but it's still one of the best performing economies in the world. Their household debt is comparatively low. So is it simple as that? They can afford to raise rates without an asset crash because debt levels are lower than they are in other parts of the world.
No, I think the debt levels are still high enough to be a crunch if rates get too much higher. Like I said, 2.5%. That's almost there's six interest rate movements from the magic number of 4%. Yeah, and I think, but long before they get to 4%, I'm really doubting they'll get past 3%. But as they start putting up those rates, then the private sector will start reducing debt again. You have a credit crunch and slow the economy down once more. So I think they're going to be a sort of a dance of the dead between the Federal Reserve not understanding credit and therefore making it more expensive for the households and corporations, and the corporations and households reacting to increasing rates by turning off the credit spigot, causing the economy to fall down once again more when the Federal Reserve goes back and reduces rates. And if you've got the data on hand, I'm pushing on my luck here with you.
Yeah, you are.
But do you have the Japanese data handy on interest rates?
Well, it's minus 0.1%, isn't it? That's what I've got here.
I'm wondering how long it has been. For that length of time.
Well, for a couple of years, and then before that, it was at zero. So it ran as zero. So you go back to 2010, it was 0.1%. Then 2011 dropped to zero, and the last couple of years, it's been negative 0.1%.
Well, actually, if you take a look, I've actually just brought some data across from Trading Economics. Looking at it right now, and they hit negative interest rates in 1999. So we're going to have 20 years, 2 decades of negative rates. There have been a couple of times they try to put rates up. One looks like about
2007,
and then 2007 as well. And they put them up and back they go down again. And
yes, that's right. Since the late 1990s, basically, it's been around zero. Yeah.
Yeah. So what you have is once you're in this debt trap, and Japan was the first country to enter it, you're stuck. And rates have to remain low. And every time you try to put them up, bang, you hit that brick wall you don't even know is there, which is the level of outstanding private debt. Credit goes negative, and bang, you're back into recession once more, and the central bank gets forced to reduce rates once more.
So in conclusion, can we now ignore interest rates as being an instrument for central banks, and we have to look more at fiscal policies and trade measures, as you were talking about with Turkey, for example?
That's a good summary. Yeah, I agree with that.
Well, we'll leave it on that point. Very good. The end of the death of interest rates. Good to talk, Steve. We'll catch you again next time.
Okay, mate. That was good.
Well, hopefully everyone else sees it that way. That's it for this time. I'm Phil Dobbie. He's Steve Keen. We're back again next week with another edition of the Debunking Economics podcast. Thanks for listening. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.